All three major indices closing just off the lows of the day. The catalyst for the market turnaround seemed to be a spike in bond yields, the 10-year jumping 15 basis points for its biggest increase since last September. That move appears to have been triggered by rumblings out of Japan, the yen strengthening against the dollar as the BOJ mulls a change to its yield curve controls. So should we should be getting that decision around midnight tonight. Rebecca, you've been watching this news. What is it? Was that the excuse to sort of lighten up here?
I mean, I think it's a reasonable move in treasuries, given that over the last decade, you've seen capital from Japan leaving in search of yield. The estimates are as much as $2.5, almost $3 trillion over the last decade in search of yield, leaving the country, including treasuries. So if the Bank of Japan decides to start the very slow incremental process of tightening monetary policy, you would assume that's going to reduce this capital outflow, and that is going to put one source of pressure up on bond yields, although I wouldn't get too excited about it. It's, if the Bank of Japan does something, it's going to be incremental. We're talking about a 50 basis point cap on the 10-year JGB now, maybe going to 100 basis points. So it's still a huge differential with policy in the U.S. and Europe, Canada, Australia, pretty much everywhere else except China.
Right, and that differential has contributed to a carry trade that we've been seeing, and so this could lead to an unwind or the start of an unwind. The new governor, Ueda, had telegraphed that there wouldn't be a change to policy, but this report that came out by Nikkei midday seemed to indicate that there could be talk of tweaking this policy, and that's what sort of got everybody on edge here.
You know, it's interesting how you framed it is like the spike in yields in the 10-year caused a sell-off in equities, and was that the reason? And think about this. I mean, we've seen the 10-year, move from basically, up to 4%. It got a bit higher there. It kind of found a little bit of a level here. And the equity market has not been bothered at all over the last, let's say, 6 to 9 months. And we've seen a lot of upward kind of volatility. So I do think it's kind of a bit of an excuse. I think the idea would be that there would be some liquidity taken out. Danny Moses was on the desk last week and was talking about this actually with Cameron Dawson. This was the thing. I think you asked the question, what's the main event? Is it going to be central bank policy, or is it going to be these big earnings? And I think both of them agreed at that. And it's interesting that the earnings, while, the ones that we were most excited about, the big cap tech ones, it's like fine. The money's moved out of them. It's found a home here. But it could be this. This could be the excuse for people to say, okay, maybe higher yields for longer is really going to be here to stay. Now that the Fed meeting's out of the way, we're not really going to hear a presser from Powell for another, month and a half or so. So maybe what the BOJ has to do is more important right now than the U.S. Fed.
Yeah. Karen, what was your take on today's move?
I wasn't really sure what it could have been. The bond move could have been a lot of things, but also it just sort of felt like things were really getting frothy. And, the combination of, that Meta call was really positive. Mm-hmm. And, it's circular, and sort of that started trading down at the same time. And I don't know, in the last 5 minutes of the day, I just shorted some spiders because I felt like, God, even though it was down 200, I just felt like, wow, what a move we've had. And, I'm always net long for sure, but this just seemed like an excuse to sell off what has been a very broad and I find impressive rally, probably too far.